Hey there, it is Corey here, CEO at Verse Wealth. Thank you for joining us for our quarterly economic and market update. I'm joined, as I normally am, by the one and only Tom Schubert, Managing Partner at Drummond Capital Partners. G'day, Tom. Thank you for joining us.
Corey, thanks for having me again.
Thank you. We've got plenty to get through. We are going to start with the economy, the Australian economy, the global economy. We're going to check in with Tom on how growth is going. What are some of the key themes? We've had a lot of talk of recessions post-COVID with interest rate rises and inflation. Those recessions haven't come. So we're going to kind of dive into that and then what might be in store as we move forward. That'll be a good segue for us all to start talking about share markets and what that means for share markets, what's been happening on the Australian market recently, what's been happening on the US market, global markets. And we'll talk a bit about big tech and how that's been driving markets in ultimately what was a really good quarter to start the year, what has been a good 6 months on markets and really a good year overall on markets as well. So there's plenty to get through. Thanks for joining us. Tom, let's dive in. We'll take it from the top. We'll start with, I guess, global growth. Tell us a bit about, I guess, what's been happening on the Australian economy, US economy more broadly, and help us get a little bit educated on how things are going.
Sure. So it's a great place to start. I mean, yes, there was a lot of talk last year about the potential for recession, and that was really driven by the expectation that all of those really rapid rate hikes that we saw, so interest rates going up very quickly, were going to bite the economy as they usually do. And we sort of sit here today in 24 and global economic growth is solid. You know, it's not too hot, but it certainly remains positive and it's not a recession. And I guess the question is, why haven't those interest rates bitten as much as they would have historically? And the big driver of that's been government spending. So post-COVID, we know the government stepped in and helped a lot on the fiscal spending side with infrastructure spending. We've seen a lot of that in Australia, in particular here in Melbourne. In the US, lots of development of clean energy projects and onshoring of manufacturing. And so that continues to be really strong and continues to support the economy. And given the US is in an election year, there'll be no way they will be pulling back any of that spending. Certainly in Australia, you know, the Labor government or, you know, right across the country, both at state and federal level, continue to spend a lot as well. And so that's continued and we think it's a positive from a market's perspective.
Yeah. Okay. So I mean, there's plenty there. Picking that apart a little bit. I guess firstly with interest rates and inflation and cost of living, like there's plenty of Aussie consumers that are suffering at the moment, doing it tough. You know, we see that amongst our client base here at Verse. From an interest rate perspective, you know, are you anticipating we're going to see any more rises? The talk is that we've kind of seen all the rises that we're likely to see, and even perhaps towards the end of 2024, we might begin to see that ease a little bit. And I guess as an offshoot of that, you know, plenty of Aussies were fixing interest rates on their mortgages and investment debt back in 2020, 2021, when we had rates at these record lows, and they were fixing often for 2-3 years. A lot of people have come off those fixed rate cliffs, and that's had a big impact on their cash flow and their ability to spend and enjoy their money. Where are we up to there? Is there much more of that pain ahead in store for Aussie consumers?
Yeah, it's a great point, Corey. And when I sit here and talk about global growth looking okay, if you're as an Australian consumer sitting here, it probably feels a bit different than that. And the Australian consumer does stand out globally as probably having suffered a bit more pain as a result of the interest rate hikes. One, we tend to have more debt at a household level than in other parts of the world. We've used that debt to buy expensive houses that are lovely to live in, but do cost a lot. And secondly, because of variable rate mortgages, and now, as you say, that reset off fixed, we felt the pain a lot more quickly of those interest rate hikes. And we can see that in the data. The retail sales data continues to fall, is sluggish. So whilst the economy is doing okay, we've still all got a job with cost of living, and so inflation in, you know, groceries and petrol and rents or mortgages, we've all got a lot less disposable income and are feeling the pinch a lot more. So that's certainly not unique globally, but certainly I think more pronounced here in Australia.
And there's like, I mean, there's been so much talk about inflation the last couple of years, and everyone in some way has felt some pain associated to that, whether it's an individual, a household, a business. I think we've had cumulative inflation of more than 20% since early 2022. I saw recently foods up like 23% since, early 2020. So, even though we've kind of curbed a lot of those inflation rises, prices stay high.
That's
They
right. They
don't they
don't ever
don't
come
they
down.
don't come back down to where they were. So we've just got a new normal, and that new normal can take a while to adjust to. So
That's right.
as you said, we've got more household debt than we've probably had at any point as well. So there's a few factors there that when you stack them all up together for the average Aussie consumer, the average Aussie household, they're going to be experiencing a bit of pain, a bit of cash flow tightness, some real stress. So I guess without me being long-winded there, the Reserve Bank's job is to decide when to raise interest rates and when to reduce interest rates. And their really only goal, it's pretty simple, really, is to like manage inflation, right?
That's
It's to
right.
make sure that it's not going up too quickly or it's not going too slowly or going backwards. So they've got this band of 2 to 3%. It's a small window. They're meant to try and keep us in that window, right?
Mm.
COVID made that pretty hard for them. We're getting closer to that window. And there's been all this talk of recessions pending for the last couple of years. We haven't had that. And I'm not seeing so many of those headlines anymore. So is that, recession risk kind of off the table? And does that mean that the Reserve Bank is, in fact, actually done a really good job in managing this?
I'd say ours has probably struggled a little bit more than others. It's been hard. So that talking of inflation, like it's come down a long way from where it was. We were running at sort of 8-9% annualized not that long ago. So and we're now down to 3 to 4. But as you point out in Australia, the target is 2 to 3. I mean, the US is targeting 2. So this last mile, this last leg, proving a little stickier, and as a result, even though ordinarily at this stage with growth slowing and the consumer sort of in Australia feeling the pinch like it is, the Reserve Bank would normally be cutting rates to prevent us tipping into recession. The challenge they have is this last mile on inflation. So because it's above target, despite the weakness in the economy, it's unlikely we're going to see them cut rates. And so we're probably just going to have to hold. So even though they're above target, given the weakness in the economy, they're unlikely to have to hike. But
Yep.
equally, until they see that inflation moderate down to target, it's hard for them to cut either. So we're in a bit of a holding pattern now, I think, with interest rates where they are.
Yeah. Okay. So if your variable rate mortgage has got a 6 in front of it at the moment, expect it to have a 6 for a little while yet is the simple news there. So moving from, I guess, the economy to markets, and I guess what a bit of this means for markets, we kind of said at the top of the conversation, markets have had a good time recently. The last 12 months has been quite positive. Our market last 12 months is probably up 5%. It's dipped a little bit in April. Maybe you can speak to that. US market's up about 20-21% for the last 12 months. It's been a really good start to the year as well. So maybe speak to that in a bit more detail.
Sure.
And what are some of the underlying themes there that are maybe driving some of those returns?
Sure. So as markets are forward looking, and so last year, early in the year, expectations for recession, a lot of volatility, but as that recession risk faded, so less chance, the markets have continued to reprice a better outlook for the economy, and therefore better outlook for earnings, which is good for equity markets. And that's really been the driver. So as inflation kept falling, it was like, okay, rates aren't going up anymore. Maybe they're going to come down. The economy is going to be okay. And so markets have been pricing in better times ahead, essentially, and have done a pretty good job of that. And so it's been starting to broaden, but still has been pretty focused on the quality large cap end of the market. Big companies tend to be less exposed to the economy and interest rates and tend to have better pricing power. So in this environment of slightly higher inflation, still high interest rates, they're much better able to manage their profitability. And so we have seen bigger companies like large cap outperform smaller companies, albeit all have gone up. The US continues to have stronger growth than Australia. Sort of seems to have better companies, usually big tech, etc. And so US exceptionalism from an investment perspective has continued, and so the US has also outperformed Australia. So they've been, the big drivers, large over small and US over Australia, have really been key drivers of portfolios over the last year. But equally, on the defensive side of portfolios, having higher interest rates means higher returns for defensive assets as well. And so we've seen some great returns from, just Australian corporate bonds, which are pretty defensive. We've delivered 7 or 8% returns over the last year. That's great if you're a retiree or you have a more balanced portfolio, not wanting to take as much risk. You're actually getting paid on the defensive side too, which is great.
Yeah. First time in a long time. I'm thinking about some of the new clients we've got recently, and portfolios have been put together for them. And those portfolios, for the first time in a long time, often including like decent money in term deposits. Because we're setting up term deposits, at 5, 6%, etc. And you can get returns without taking the risk and the volatility. And it hadn't really been that way for, more than a decade, really. So, the balanced portfolio is in a much better place at the moment than it's been for the last decade. A lot of people have been forced into the share market to generate some returns because they can't get them from cash, they can't get them from bonds, they can't get them from term deposits. So that's positive. So you're kind of diving into the US doing really well relative to the rest of the world, particularly Australia. One of the themes that I think we've spoken about quite regularly in these quarterly conversations that we have together is big tech, and that the large technology companies have driven a lot of those US returns. If we look at the 10 largest companies in the US now, I think maybe 7 of them, maybe even 8 of them are large tech companies, and some of them have done tremendously well. So when we're talking about US market last 12 months being up 20%, that's not the whole market. It doesn't mean the top 500 companies are up 20%. I mean, some of them are really struggling, some are kind of neutral, some are doing pretty well, some are doing tremendously well. So Amazon's up 75% for the last 12 months. Nvidia, which is kind of the gaming chip company, maybe the 3rd, 4th largest company in the world now, it's up 250% for the year. So some of these tech companies have really done exceptionally well. And that is, I guess, dragging a lot of the market with them. Is that still a really strong theme? Is that less of a theme than it was last time we were talking? And, I guess add any more meat to the bones that you'd like to there, Tom?
Sure. Up until about October last year, the only game in town was what was coined the Magnificent Seven. It was the 7 big tech stocks, including Tesla, which I don't really classify as tech, but it was caught up in the AI-driven, rally in tech stocks. So anything linked to artificial intelligence, and post us all discovering ChatGPT, it was like, wow, AI is the new theme. Who's the beneficiaries? Those big 7 stocks. And they were really the only thing that was working through to about October. Since then, we've seen the markets now recover on the basis of a better outlook for the economy. And so there has been other companies, other parts of the market that have performed. And the market's been quite rational about repricing the tech companies exposed to that theme. So the ones that have really delivered on earnings based on the artificial intelligence, the AI boom, like Nvidia, which makes the chips that go in the cloud, like the cloud companies in Microsoft and Amazon, we've really seen those companies deliver on their earnings and the market reward them, whereas companies like Apple that don't have quite the same exposure to AI and have also got exposure to issues in China, or Tesla, which is facing competition from cheaper Chinese electric vehicles, for example, have been sold off quite a bit. So we think the market's become, it's not just about buying the theme, it's now about buying who's actually delivering the earnings from that theme. And so the market, we think, has been pretty rational in the way that it's going. But those big tech companies still continue to be very important for the health of the market and the performance of the market.
Yeah. Okay. Well, I think overall that's real positive. If markets are being rational and they're not overinflating prices based on some themes, and they're actually prices are more reflective of how these businesses are actually performing from an earnings point of view, a growth point of view, a profitability point of view, that minimizes risk for investors. It doesn't take volatility away, but it means that we've got more appropriate pricing on markets, which overall is a good thing. Perhaps my last question for you, Tom. We've seen some volatility in markets in April. Markets got a bit wobbly. They've come off a bit. They've given up some of the early gains that we posted in 24. What do you see as the opportunities for investors from here moving forward? And what are the kind of things that perhaps you or your team might be thinking about?
So after a great 3 months, 6 months, really since the October lows, a great run in markets. We have seen a pullback in April, and that is absolutely normal. First and foremost, that happens. Markets go up quickly; they need to consolidate, and the drivers of that kind of pullback, if you will, have been one, inflation numbers just coming in a little bit hotter than expected, and so the market having to price out expectations for interest rate cuts this year, and that was one of the key drivers that lifted the market earlier. We also saw a bit of escalation on the geopolitical front between Iran and Israel. That sort of spooked the market, and the oil price went up a little bit. Again, given all of this, peak to trough, I think the S&P got down like 6%. It's bounced back a little bit. It's down 4%. Like compared to the 20+% run it's had, it's absolutely normal that it does that. And given that it's been, as I said, quite rational with pricing companies and their earnings through this period as well, we would see that as a healthy response to a little bit of a short-term change in the outlook, and just brings about a period of consolidation. For us, we watch, the key data points that are like inflation over the next month or so. Keep watching the earnings picture, but really we'll see any pullback as an opportunity to buy, given that, as I said, markets are pricing reasonably rationally, and growth is still healthy.
Okay. Well, thanks for the update there. Again, I think that's largely positive. That was my second last question for you. My last question, I promise, is this. You mentioned that there's US election coming up later this year. It's the first week of November, so it's pretty much 6 months away. And it's likely to be quite significant. Do you anticipate that the run-up to the US election is going to impact markets in any meaningful way?
It's a great question. It's something that we watch. If we start on the premise that markets are basically open and therefore they're rational in the way they're pricing, they're capturing all the available information, and right now Donald Trump is ahead in the polls. He's the Republican nominee, and we've had to endure 4 years of his policy already, so we sort of know what we're going to get. Some ways we would argue the market's priced for him being elected later this year. And that may concern people with respect to what does that mean? But in some ways you could argue it's already in the price. Having said that, it may not go that way. We may get status quo, and maybe Biden gets re-elected, and given his policies quite pro-growth, they're spending lots of money, maybe we get a positive surprise on the other side. Equally, we know not to try and predict what Trump will do, and so maybe he gets elected and completely pivots another direction, and that may have a short-term market impact. At this particular point, it's quite difficult to build an investment case around that. Like I wouldn't be too concerned. Signs of it kind of deviating quite strongly another way, maybe you want to change your view, but for now we'd argue it's sort of in the price.
Yeah, sure. Okay. And for those that are interested in terms of betting markets, because often it makes sense to follow the money, Donald Trump and Joe Biden at this point are about even money. So who knows how things will pan out there later in the year. Tom, appreciate your time as always. Your insights, that's been helpful, I'm sure, to all of our clients that are listening, and looking forward to having you back on here in about 90 days time. But in the meantime, look after yourself, your family, your team, and if you're a client of ours and this conversation leads you to having any questions, or you want to chat with your advisor about your portfolio or your strategy, we are always here. Just get in touch, and we'll make time to chat. So again, Tom, thanks for joining us.
Thanks, Corey. See you next time.